Hello friends, welcome to part 2 of net present value discussion. If you haven't seen the previous video, I will leave a link in the description section and you can go and watch it. Just a reminder that our exercises are taken from the 15th edition of Garrison Brewer Managerial Accounting book. In this exercise, we have a comprehensive problem. That is problem 1323. In this problem, we have Lou Balu, who is a divisional manager for Savage Company, has an opportunity to manufacture and sell one of two new products for 5 years. So the investment will take a period of 5 years. His annual pay raises are determined by his divisional return on investment. This is what you should keep in mind. And it has exceeded 18%. Okay. So he has had a raise in pay according to his ROI. And the ROI at we speaks now is at 18%. So anything below 18% from an investment means his pay is going to decrease, or his bonuses or his pay is going to decrease. Okay, so he has an opportunity to decide whether to invest in product A or product B. We have product A here and we have product B. So, but the company's discount rate is 16%. Okay, and we are going to solve the remaining problems. For the sake of time, I have some templates put in here so we can go faster than normal. Number one, it says calculate the payback period for each product. What does it mean, payback period? Payback period simply means how long is it going to take Lou to get his investment back. If he invests 170,000 in product A, how long is it going to take him to get that 170,000 back? Is it going to take him exactly 5 years? Is it going to take him less, or is it going to take him even longer than 5 years? That is payback period. With that, we have to know the investments required divided by the annual net cash inflow. How much is Lou putting in product A? And that is 170,000. Okay, so put in 170,000. But what is the annual net cash flow? We have the data given out here. Okay, annual net cash flow simply means at the end of the period, if we take our revenue and take out all our expenses, that only does with cash transaction, how much cash is going into our cash account at the end of the period. Okay, so we'll take the revenue and subtract all cash transactionary expenses from the sales. Remember, depreciation expense, we don't pay depreciation with cash, so you don't consider that when you're dealing with annual cash inflow. And when you advance and you're doing cash flow statement in chapter 14, you will understand what I mean by not including depreciation expense when you get to chapter 14. But let's deal with this. We have the sales of 250,000. And then what are our expenses? We have variable cost or variable expenses as 120,000. And then depreciation, no, we don't include depreciation because it doesn't deal with cash. We only include fixed out-of-pocket expenses. That's fixed cost, which is 70,000. So what is our annual net cash inflow? We take sales and we subtract those two expenses. That gives us 60,000. So we just reference the annual net cash inflow to this one, like this was 60,000. And then we divide 170 by 60,000. That gives us 2.383 years. So that means it's going to take Lou 2.83 years to get the 170,000 he is investing in project A. Great. Now let's compare that to project B. Project B, we will copy and paste this one here. What is the investment required for project B? Investment required is $380,000. So we'll put in $380,000 here. Okay, and then, but what is the annual net cash flow? We will do the same thing we did with product A. The sales are 350,000. We have here 350,000. What is the variable cost or variable expenses? 170,000. What is depreciation? No, we don't include depreciation. We move on to 50,000 of fixed expenses. We give that this, and then we take the revenue and we subtract those two expenses. That gives us 130,000 of annual cash inflow. So the annual cash inflow for project B is 130,000. Reference that. That means project B will take 2.92 years to get the investment back. So comparing these two, if you're a manager, which one will you invest in? You invest in A, according to payback period, because it will take you less period, or it will take you a few months than B to get your investment back. And you want to get that investment back, so the remaining will just be a profit for you. Great. Let's move on with number 2. It says calculate the net present value for each product. So net present value, we find the initial investment, we find annual net cash inflow for each year, and then we compute it as it goes. So I'll reveal this one. We have investment required as at now. So what's the investment required for product A? Because remember, because this is a cash outflow, cash is going out, it becomes negative because cash is going out of your cash account. It's not cash coming. This is cash going out. So you are investing 170,000. So you reference it with negative in front of it. That gives us 170,000 negative. And then what's the cash inflow annually? So every year we get 60,000. So I'm going to reference the 60,000. Just drag it to year 5. Okay. So these are the years we invest 170,000, but every year we get 60,000. What's our net present value? This is how you compute net present value. You put equal to, you type in NPV, and Excel knows what you mean by that. So you open parentheses, okay? What is the rate? The rate here is for 16%, okay? Which is not the 18%, but 16%. 18% is the ROI that the manager has had from the return of investment, but it's 16%. So we type in 16% here, we type comma, and then we select all cash inflow for the period. We close the parentheses plus 170,000, that is the investments required, and then we type in. I'm going to do that again. Equal to, type NPV, open parentheses, type in the rate, that is 16%. 16%, type comma, select cash inflow, all cash inflow together, close parentheses, plus cash outflow, type, and enter, press enter. So net present value is 26,457.62. Now, what about project B? Because we have already computed it, copy and paste it here, and then our net present value for project B is 45,000. So based on net present value, we know that project B will be preferable, more preferable than project. Well, Lou Ballo will prefer project B to project A when it comes to net present value. Now let's move on to requirement number 3. It says calculate the internal rate of return for each product. So I will type in internal rate of return here. And then what we do is you type in equal to, you type IRR for internal rate of return, and Excel knows what you mean. Open parentheses and select every cash outflow and inflow. Close parentheses, enter. That gives you 22.50%. Now, because we already have that, I will copy and paste it here, and then it's computed for project B, 21.05. And which one would you prefer? Project A, when it comes to internal rate of return. Now, question number 4, calculate the profitability index. Profitability index for each product. Here we find the net present value divided by the investment required. What is the net present value for project A? We have it here. So we select net present value divided by investment required. What are the investment required? 170,000, and we have it here, 170,000. So we select 170,000. Then we divide net present value by the 170,000 of investment required. That gives us 0.16 here for product A. Now, let's copy and paste that for product B, and that gives us 0.12. So, based on profitability index, we know product A is likely to be accepted by low. Now, 5. Calculate the simple rate of return for each product here. Here, you get to pay extra attention when it comes to this. It's computed as annual increment net operating income. Net operating income is slightly different from annual cash inflow. Net operating income is your revenue minus all operating expenses. And all these expenses are operating expenses. So we will subtract all of them from our revenue. And because we did not subtract depreciation here, we're going to subtract depreciation from the annual cash inflow. Okay, does that make sense? So your net operating income is payback, which is the 60,000, annual cash inflow, minus the depreciation. What was the depreciation for product A? 34,000. So we type in 34,000. That gives us 26,000. Okay. And if you want to double check with that, let's see what we have here when we do it this way. Okay. So we know we have the revenue of 250,000. Okay, so we have revenue of 250,000 minus all the expenses. So we'll minus 120,000 minus 34,000. Here we are subtracting 34,000 because it's an operating expenses. Okay, so when it comes to net operating expense, we subtract all the expenses that are operational minus another 70,000. That gives us 26,000 that we have here. Okay, so you only take the net cash inflow, so you don't have to go through this long process. You only take the net cash, net cash inflow and subtract the depreciation expense. And now we have initial investment. What were the initial investments required? That was 170,000. So you put the 170,000 here, and then we take 76,000 divided by 170,000. That gives us 15.29%. We will do the same thing for project B, okay? And this is wrong because we do not have it computed right here because just reference it. So what we will do is we will take annual cash inflow for project B, which is 130,000, and then we will subtract the depreciation expense, which is 76,000. So we'll type in 76,000, okay, and that gives us 54,000. What is the initial investment? Initial investment was 380,000. 380,000 here, and then we will divide 54,000 by 380,000, and that gives us 14.21%. Okay, does that make sense? Great. When it comes to net operating income, it's all expenses, all operational expenses. But when it comes to net cash inflow, you only subtract expenses that deals with cash. Depreciation does not deal with cash. That's why you don't subtract it. Now, number 6 asks us, which of the two products should low division pursue? Okay, which one should he pursue? When we think about the 1, 2, 3, and 4, we know with number 1, project B is better. With number 2, with number 1, project A is better. Number 2, project B is better. Number 3, project A is better. Number 4, project A is better. Number 5, project A is better. So it's likely that project A is better than project B. But with a simple rate of return, 15% is lower than 18% here. Okay, so that means Lou is going to lose some annual pay raises. So he is likely not going to accept the investment of these two. Okay, he may not accept the investment of this because the simple rate of return for both projects are lower than the historical rate of 18%. Great, makes sense. So let's move on and do this one, which exercise 13.17. Okay, let's try our hands on that. So I just copied and pasted this one here. Okay, but number one says, what is the project net present value? Okay, feel free to pause the video and then solve it, and let's see if you get it. Okay, after I compute it. So pause the video now. Okay, well, did you get it? Let's find out. What's the net present value? So we know from our previous discussion, we find the investment required. Okay, what are the investments required as we read the problem? So it says Casey Nelson is a divisional manager for a pigeon company, which is similar to the previous problem we saw. His annual pay raise are largely determined by his divisional return, ROI, which has above 20%. So this one has 20%, okay? Casey is considering a capital budgeting project that will require 3.5 million investment. Okay, the company's discount, I'm just reading the most important ones. Useful life of 5 years. Okay, so it's going to take 5 years, and the company discount return is 16%. That's the same as the previous one. So what we're going to do is, what is the requirement? Investment required was 3.5 million. So 3.5. Oh, I already have it here. 3.5. Okay, so 3.5 million. Now that is the cash that is going out. Now, what is the annual net cash inflow? Okay, annual net cash inflow. Here we have the net operating income. So remember, because they have taken an expense that does not deal with cash, we will add it back to this. Okay, so what we do is we have 400,000 plus the 70,000 here, 700,000 here. Because 700,000 is not cash transactional, so we shouldn't take it out when it comes to net cash inflow. So we will just reference this one and then we drag it all the way to the bottom. Okay, so we have this as this. Okay, so every year net cash inflow will be 1,100,000 for the whole 5 years. And then net present value, remember you type in NPV, you open parentheses. What is the rate? The rate is 16%. So 0.16, you type comma. And then you select all cash inflow, okay? You close parentheses, plus the initial investments required. So we have 101,723.02 as net present value. Okay, makes sense? Great. Let's move on. What number 2? What does it say? What is the project internal rate of return for the nearest home? Okay, so I'm going to show you this rate of return. The project internal rate of return. Okay, so we have the same things here. We're going to use the same thing. So if you won't mind, I will just reference it. So we have the same amount here, internal rate of return. This internal rate of return, just like we did in the previous video, we're going to do the same thing here. So you type in IRR. Okay, you type in IRR, you open parentheses and you select all cash inflow and outflow. You close parentheses, you press enter. So internal rate of return is 17%, and it might be a little less or more, okay? 17.24%, that's the most accurate one. That's internal rate of return. Okay. Now you can pause the video and see if you can get the number 3 as well. What's the project simple rate of return? So pause the video now. Okay, Welcome back. Great. So what we do here is net operating income divided by initial investment. What was our net operating income? That was 400,000. So we type in 400,000. What was the initial investment required? The initial investment was 3.5 million. So what we do is I'll put negative here and select the 3.5 million. And then what I would do, I would divide the 400,000 by 3.5 million, and that gives us 11.43%. That's internal rate of return. Question number 4, it says, will the company want Casey to pursue this investment opportunity? Will Casey, wow. So here, will the company want him to pursue this? The question is yes, because the net present value is positive. They haven't lost anything, and they are having some return on the investment. But Casey himself will not do it, will not want to do it, because remember, his pay raises depend upon his ROI, and his ROI is 20% right now. So 17% or simple 11% means he's going to lose some pay raises. Okay, that means he's going to lose some pay raises. Okay, so that is number 4. You can put in your own words. Okay, so thank you for watching today's edition. We will continue with chapter 14 or chapter 15 when we meet again. And chapter 14 is going to be fun. That is cash flow statement. Okay, so feel free to go back and review the video where you think I went faster than your pace. You can pause it and just review it. And I will see you again next time.